This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 20th. Some highlights from today's show. The Fed inflation debate is hotting up. We're going to discuss some gold technicals, and oil below 72.50 is interesting. A very happy Thursday to all of the day traders out there. Welcome to today's show. We're going to start off talk a little bit about some of the overnight moves. It's a very quiet European session. Of interest, of course, Asia sold off quite aggressively. It was quite a bit of a profit-taking move in some of the tech space there, with the Topex down 1.2 and the Hang Seng down 1.6. Now, obviously, I would have expected that to feed into the European session, but we did, of course, see Europe very heavily down on the day yesterday. So right now, as of on the screen, we can see DAX is up around 100 points. I do suspect at some point we trade flat again in the DAX, so keep a close eye on there. I think there is a continuation move perhaps to a retest of yesterday's low in the DAX. That being said, there's not a great deal going on. It is very muted conditions. We do, of course, know we've got the OPEX coming tomorrow, and that's why the market is very muted, very, very low volumes. Let's then turn our attention and talk about our first topic today, which is all about, of course, the Fed and ultimately the minutes that we got from the Fed. Now, the key takeaways from it ultimately is that the Fed remains adamant that they are on the cutting cycle. They will again cut this year, but they pointed out, and I think this is quite interesting, they pointed out ultimately that there are upside risks now to the inflation outlook. Now, it's not necessarily new news, but ultimately what it's leaning on is this idea of until those upside risks dissipate, we are on pause. Okay, so there's perhaps now a sense that this is going to be a bit of an indefinite pause, a pause at least until the middle of this year. But in terms of transitions of how communication works from the central bank, typically the way you can look at this is now we are on pause until such a point that inflation begins to move back down. If it doesn't move back down and it stays at these elevated levels we've seen over the course of the last two prints, ultimately, eventually the Fed will then have to make a decision to either declare that this is the new neutral rate and there are no more cuts. And if that doesn't ultimately bring inflation back down, they will then have to transition towards communicating, perhaps needing to go more restrictive again. Okay, so there's a transition, and the unfortunate thing for us as day traders is it doesn't happen overnight. This typically happens over the course of a couple of months. That being said, of course, a lot can happen between now and the March meeting and the meetings beyond that. So it's very much a data-dependent approach from the Fed. What was also of interest was they did tell us that the reasons there's a bit of concern is ultimately what's going on with regards to Trump's policies around trade and in particular immigration. Okay, I think there is a general thinking now that the Fed doesn't really fully understand the implications of it, but there is, of course, the risk that it does lead to more household spending, disruption in supply chains, and as a result, higher inflation. Now, there's also a bit of talk that businesses are, of course, looking to raise prices and pass on those prices to consumers, so long as, of course, consumers can handle those higher prices. And that is what's leading, ultimately, participants to think that inflation expectations are rising. Okay, I think that's a very key thing we've been discussing for some time now, which is inflation expectations in the US are quite hot. Now, again, it's not about, how long, it's not about them being high at an absolute level. It's about them being at a high level for a long period of time. Okay, if inflation expectations 5 years out, sit at 3.5% for a period of 6-7 months, at some point the Fed will need to accept and acknowledge that policy is not restrictive enough. Now, that's a nice segue into our first topic for today, and it's all about gold. I think gold is a very fascinating market at the moment. If you're not scratching your head about why gold is the star outperformer, not just last year, but also this year, it's because very clearly at a fundamental level, the investors are not happy with the current policy stance of the Fed. Now, what you've got in front of you is a chart in red of the price of gold and in green what we call real interest rates from the US. Okay, now how you have to think of this relationship between gold and real rates is that when real rates are very, very high, it makes no sense to hold on to gold because you can earn a yield holding on to US bonds. So you have to ask yourself, why is it that over the course of the last 2 years, real rates have been high? We're seeing real rates somewhere around 2% in the US. and yet gold was up 30% plus last year. It's up 12% plus this year. Why is it that that relationship has broken down? Okay, we have to answer to that, because technically speaking, if we go back and we look at the 2009 to 2013 scenario playbook, we can see those inflation expectations completely squashed after the Fed began QE 1, 2, and 3. And as a result of that, we saw the gold price rally from $800 all the way to $2,000. Okay, so that is the traditional relationship, which is lower real rates does lead to higher gold prices, and yet we're not seeing that relationship. And so you need to answer that question. The short of it, unfortunately, is that market participants just do not think that 1.9% real rates justify owning US bonds. Okay, there's a lot of concern now around fiscal sustainability in the US. We of course saw this topic of term premia crop up late last year. It continued this year. We saw bonds sell off as a result of that, and yet still gold continues to climb despite the fact that we do have elevated real yields. It's as simple as no one wants to own bonds at these yields because they simply just do not justify the risk. Okay, and until that happens, until we see these real rates move higher, whether that comes via inflation moving back to that 2% target or the Fed telling us they're going to turn more hawkish, until that point, gold's going to continue to soar to new record highs. So keep that in mind. Now, another chart, another way to look at the price of gold is to actually go and plot the price of gold in yellow with a couple of moving averages. But the key moving average to always pay attention to for any market is the 200-day moving average. That's the annual rate of change of price of any product. And what you can see is that gold has not even come close to its 200-day moving average ever since start of 2024. What did the Fed tell us? They said they're not going to prioritize getting inflation back to target. Instead, they'll kick it down the road, and they'll prioritize the labor market and, of course, growth. The result, gold moved from $2,000. We're almost up at $3,000. The point being is that market participants are not happy. We can see that not just at a fundamental level, but also at a technical level, because we have now got, call it a $300, almost a $400 gap between the 200-day moving average and the price of gold. Okay, that should not be ignored. It does tell us exactly what's going on, both at a technical and fundamental level. Now, it's not to say we don't have a corrective point coming in. I do think gold at these levels perhaps is a little bit overbought, and we are going to see these little short-term setbacks. And with that in mind, I think gold is very much again in play today on the short side. We've got a little bit of a pattern repeat from what we saw over the course of the last week. So I'm going to take you back to last week. We of course had a very interesting top put in around this 29.64. If you go back to the start of Friday, you can see the market sat around those highs. We had that sort of very significant two-way trade where, for all intents and purposes, I think day traders were positioning for that breakout. Ultimately, it got very congested up there, a lot of weak longs, and they all got flushed out. And then we started to creep our way back up early this week. Now, I suspect a very similar pattern repeat, which is we got a very key auction reversal, market straight line bid in towards that record highs. This morning, we've seen a lot of congestion, a lot of weak longs buying it up there again, looking for that continuation pattern. We get back below 29.64. I suspect this is all going to get washed out pretty quickly. And I don't think 29.33 is where you buy it. In fact, I think you have to be careful at 29.33. I think that's where you want to be very aggressively selling it for that move back down towards that 29.10s. Okay, we are very much in a firm sideways range, stuck between 2900 to 29.65, and we like you to stay in this range until further notice. Why? Because the market's just a little bit overbought. Okay, that being said, note, I'm not looking to fade randomly. I'm looking to sell it back below 29.64. Therefore, I can have a very, very tight stop, call it $8 stop, looking, of course, for a decent $50 move to the downside in relatively quick space of time. Okay. Let's turn our attention. I was asked about this yesterday, which is, can you talk a little bit about oil? There's a very good reason I don't talk about oil, because absolutely nothing is going on in the oil market. As a day trader, as a futures trader, my job is to trade where the opportunity scope is. Now, how do we define opportunity scope? Well, one of the best ways to do it is get a 200-day moving average on your chart. And if we are oscillating and trading on both sides of it, you don't want to be trading that market. It's effectively a market that's moving sideways. And what that means is there's a lack of volatility and therefore a lack of opportunity Okay, that being said, at a technical level in terms of oil, what will bring me into play, what will bring me into interest of this is effectively if we do hold this week below the 72.50. Okay, oil looks weak. We opened the year, we staged a bit above that 200-day average, got sold straight back below it. You can see it's tested it once, it tried to test it again, and this key level that we spoke about quite a lot at the end of last year, 72.50, is now seeming to act as resistance on the market. So keep a very, very close eye. If we close below there today, I am looking for a breakdown below yesterday's lows for us to then come and test in the weekly low, and ultimately over the course of the next couple of weeks to move back in towards the lower end of last year's range. Okay, keep in mind the oil market's weak, China's weak, OPEC desperately wants to increase supply, but they cannot. They have to maintain the current stance of not increasing supply for fear of sinking oil prices lower. So there's obviously a number of other factors that do drive the price of oil, but keep in mind Europe is in a recession. The US, of course, growth is now slowing there. We have an ongoing tariff war. It's not exactly a pro-demand type economy across the globe right now. And until we do get some growth shoots, until we do get some significant spending and growth somewhere, I do suspect oil remains a sell-only market. Okay, but that being said, it's not an easy sell market. We can, of course, see that it isn't doing a great deal. But like I said, pay attention to that close at 72.50s, as that will obviously give you an idea of what comes next. All right, let's then turn our attention, of course, into today's session. Like I said, tomorrow is OPEX. It is taking the attention of market participants. I do suspect another muted session today. What it does mean is we do need to sit there, try and buy the dips in the S&P. That has been the favored play, is anytime you get a little bit of sell side vol, is to just try and buy into that S&P. Look for those very, very narrow opportunities. Unfortunately, what that does mean is your symmetry in terms of risk reward is very symmetrical. You're kind of looking at one-to-one type risk reward plays. So if you want to play in these markets, you've got to accept that there's limited upside, and you do need to, of course, always manage that risk. If there are any other questions, do post them into the Discord channel. And the question for today, please do post in the comments. What market would you like me to do a technical analysis on? Do post those in the comments, and I will get to them over the course of tomorrow. That's it for today then. As always, manage that risk, go make some money.